Hello, welcome back to Core Finance. I'm Matt Brown. I'm joined by Marc Ostwald, who is a global strategist at ADMISI. Good morning to you, Marc. Now, obviously, the headlines, business headlines, deal with Brexit, etc. Let's put that to one side, though, because there's a lot more going on in the markets, actually, that probably mean more for the global markets and trading today that investors probably aren't focusing on.
Yes, indeed. I think in the first instance, obviously, we've had the Chinese trade data overnight, and they came in way better than expected. Imports around the 17% mark. We were expecting about 11. Exports also very strong. The commodity imports were particularly strong, pretty much in any category you care to think of: iron ore, steel, soy, even coal. Though I'll come back to that in a minute. Crude oil, another strong one. LNG, because they're gradually switching from coal to natural gas to heat homes. But I think the very simple message from the Chinese trade data last month, when we had the trade data, and obviously October includes the National Day Autumn Festival week-long holiday, everyone sort of jumped all over it, saying, well, this is that sign that we've been waiting for all year, that the Chinese economy is now starting to lose traction because the fiscal stimulus is largely done, and we're back to that doom and gloom mode. Well, you know, let's roll back the tapes a little bit. At the end of last year, when the IMF made its forecasts, it was looking at 6.3% growth, and I'd say ballpark figure for most people at the start of this year was 6.2, 6.4. It'll certainly come in around 6.8, so it's been considerably better than expected, a bit like the Eurozone, surprising on the upside. But I think that's important because, yes, China does have a lot of challenges. It's got the environmental challenges which it's trying to deal with. It's trying to lean all over leverage. It's also trying to rein in some of its credit problems. But we shouldn't count the economy out, and I think that's been one of the most encouraging parts of this year. Why we've almost got to 4% in terms of global GDP is that we've had strong contributions from places which we wouldn't have otherwise expected. Indeed, Japan, GDP numbers revised up very, very sharply. I'm not really quite sure why people weren't quite on this, because when we got the CapEx survey last week, it pointed to something north of 2% seasonally adjusted annualized rate. So, you know, the stories there is encouraging. I find it interesting, actually, that the FTSE was more responsive to the slight uptick that we saw in response to the pound, and very unresponsive to Chinese trade data.
Especially with all the miners.
With all the miners and the oil companies that we've got in there, you would have thought it would have got actually a bit more of a boost. So I think that probably tells us we're a little bit year-endish and people are being a little bit Pavlovian. But obviously our big number today is going to be the US labour data. It should be the first clean month of labour data that we've had.
No hurricane effects.
Yeah, no hurricane effects. And the forecasts, in a certain sense, reflect that. I think it's without a doubt the case that, as has been the case for 6 to 9 months now, the average hourly earnings numbers are going to be more important than payrolls. But let's deal with payrolls first. We're looking at 195,000. That's way above the equilibrium rate, which is a growth rate, i.e. the rate at which the unemployment rate stays the same, which is expected at 4.1. And per se, I think that the risks that we've got just going forward on those two elements is, at what point, if we dip the unemployment rate below 4% and we put a 3 handle on that unemployment rate, does the pressure on the Fed mount regardless of what's happening with our average hourly earnings? But it is average hourly earnings which are going to be seen as the most important element. We've had 0.5 back in September. That was a hurricane effect. Last month we had 0 on the month, and that took us, in terms of year-on-year rate, all the way down to 2.3%, and people bemoaned the lack of any sign of wage pressures. This month, with the 0.3, we are looking at something like 2.7. Now, it's not hugely different, but at least it is signalling that we're gradually heading towards 3%. And I think those at the Fed, those that are expecting the Fed to cease and desist desist next year or to be rather more cautious under Mr. Powell, probably need to keep a closer eye on this, because if it does come in at 2.7 and say when we get the December report we get up to 2.8 or 2.9, I think that the chances are that we can definitely pencil in at least 3 rate hikes next year. I still have an end point of around 2.5%, so we're not going to be too far, assuming we get that move next week. But overall, it does underline that despite all the excitement in financial markets about the tax reform plan, the US economy, I wouldn't say it's overheating, but it's actually doing really well. And one still does have to ask the question, what do we need this tax reform for? I think that's very much a big question. What's the necessity of it? I don't actually think, as it's currently being outlined, whether it's the House version or the Senate version, which finally actually gets the biggest traction in terms of the final bill, I don't think it's actually going to do a lot for the US economy in any case. It might help corporates at the margin, but I think the repatriation will be a lot less than people expect. But overall, this is obviously the last bit of major data that we get before next week's Fed meeting. Definitely going for another 25 basis point. What we will be really looking at on that one, obviously, is how the dot plot changes, because there's been inferences from some of the quasi-hawks like Mr. Harker that they actually might be reining back on their expectations for next year. And that will be the thing that the market's most sensitive to. So we'll have to watch that very, very carefully.
Well, fantastic. I mean, a great little rundown. Important things to look out. Look out for China. Stellar year thus far. But all eyes to the Fed next week, and we'll have a catch-up then to discuss what has been decided.
And all the other central bank meetings that we've got next week, ECB, BOE, SMB, crumpets. I thought we were meant to be winding down for Christmas.
Far from it. The year is not over until it's over. In the meantime, Marc Ostwald, thanks very much for joining us.
Pleasure.